Hey everyone, welcome back to my channel. This is Advent Traveler. Today, we're uncovering 8 US companies that are shockingly on the verge of collapse in 2025. These aren't obscure startups. Some of these names might surprise you, as they were once household giants. Changing consumer habits, bad management, massive debt, and the rise of AI automation are creating a financial storm. And not every brand is prepared to weather it. Subscribe now to stay ahead of economic shifts and explore smarter ways to live and earn. Rite Aid, once a staple in American neighborhoods and one of the largest pharmacy chains in the country, is now facing a crisis that threatens its very existence. In 2023, the company filed for bankruptcy, a move that sent shockwaves through the retail pharmacy industry. Hundreds of Rite Aid stores are shuttering their doors, leaving communities without convenient access to prescriptions and everyday essentials. The company's downfall can be traced to a combination of overwhelming debt, poor leadership decisions, and mounting legal troubles, particularly lawsuits related to its alleged role in the opioid crisis. As competitors like CVS and Walgreens continue to thrive, Rite Aid has struggled to keep up, losing both market share and customer trust. Financial analysts warn that unless drastic changes are made, Rite Aid's future looks bleak. Employees face uncertainty, and loyal customers are forced to seek alternatives. The story of Rite Aid serves as a cautionary tale of how mismanagement and legal woes can bring even a once mighty company to the brink of collapse. Once a staple of American retail, Bed Bath & Beyond was the go-to destination for everything from kitchen gadgets to bedding, famous for its endless aisles and those iconic blue coupons. But after years of declining sales, shifting consumer habits, and mounting competition from online retailers like Amazon and Wayfair, the company found itself struggling to keep up. In 2023, Bed Bath & Beyond filed for bankruptcy, marking the end of an era for the home goods giant. The bankruptcy led to massive liquidation sales, with once busy stores now filled with empty shelves and deep discounts as the company tried to clear out inventory. In a last-ditch effort to survive, the brand was acquired by Overstock.com, which is now relaunching Bed Bath & Beyond as an online-only retailer. This move aims to leverage the brand's recognition while cutting the costs of physical stores. As a result, Bed Bath & Beyond's brick-and-mortar presence is vanishing from malls and shopping centers across the country, leaving behind empty storefronts and a cautionary tale about the challenges of adapting to the digital age. Once hailed as a tech unicorn, WeWork set out to transform the way people work by offering flexible, stylish co-working spaces in major cities worldwide. At its peak, the company was valued at $47 billion, attracting massive investments from SoftBank and other major backers. But behind the scenes, WeWork's rapid expansion masked deep financial problems. Leadership scandals, especially involving co-founder Adam Neumann, shook investor confidence. The company's failed IPO in 2019 exposed unsustainable losses and questionable business practices. As demand for office space plummeted during the pandemic, WeWork was forced to close locations and lay off thousands. Despite restructuring efforts and new management, the company continues to struggle with mounting debt, declining occupancy rates, and ongoing legal battles. Today, WeWork teeters on the edge of bankruptcy, serving as a cautionary tale of how hype, unchecked growth, and poor governance can bring even the most promising startups to the brink of collapse. AMC Entertainment, once the world's largest movie theater chain, became a household name during the meme stock frenzy of 2021, when retail investors sent its stock price soaring. But beneath the hype, AMC's financial troubles have only deepened. The company is still saddled with over $4 billion in debt, and despite a brief post-pandemic surge, theater attendance remains well below pre-2020 levels. The rise of streaming giants like Netflix, Disney+, and Amazon Prime has fundamentally changed how people watch movies, making it harder for AMC to fill seats. Even blockbuster releases can't guarantee packed theaters anymore, and many locations struggle to stay profitable. AMC has tried to innovate, offering premium experiences, new food options, and even accepting cryptocurrencies, but these efforts haven't reversed its downward trend. With high operating costs, fierce competition, and a shrinking customer base, AMC faces an uncertain future. Unless it can reinvent itself or find new revenue streams, 2025 could be the company's final act. Once the go-to for celebrations, Party City was synonymous with birthdays, graduations, and every kind of festivity. For decades, families flocked to their stores for balloons, costumes, and party essentials, making it a staple in American retail culture. But in 2023, Party City filed for Chapter 11 bankruptcy, sending shockwaves through the retail industry. The company cited mounting debt, supply chain disruptions, and a sharp decline in foot traffic as major reasons for its financial troubles. Since then, Party City has been closing stores across the United States, leaving many communities without a dedicated party supply store. In some regions, entire shopping centers have lost their anchor tenant, impacting neighboring businesses as well. Rising inflation and declining event spending are key factors, but the shift to online shopping and competition from big-box retailers like Walmart and Amazon have also played a significant role. As more people opt for digital invitations and DIY decorations, Party City's traditional business model faces an uncertain future. The company is now attempting to reinvent itself by focusing on e-commerce and smaller, more efficient store formats. However, with consumer habits changing rapidly, it remains to be seen if Party City can bounce back, or if the party is truly over. Once a titan in the American trucking industry, Yellow Corporation's collapse in 2023 sent shockwaves through the logistics world. Founded in 1924, Yellow grew to become one of the largest less-than-truckload carriers in the U.S., employing over 30,000 people and moving freight for countless businesses. But years of financial mismanagement, mounting debt, and costly mergers left the company vulnerable. Labor disputes with the Teamsters Union further strained operations, leading to missed payments and eroding trust with customers. As competitors modernized and the logistics industry consolidated, Yellow struggled to adapt, falling behind in technology and efficiency. When the company finally ceased operations, thousands of workers lost their jobs overnight, and shippers scrambled to find alternatives. The bankruptcy not only marked the end of a nearly century-old institution, but also highlighted the intense pressures facing traditional trucking firms in a rapidly changing market. David's Bridal, once the go-to destination for American brides, is now facing its second bankruptcy in just a few years. The company's struggles reflect a dramatic shift in wedding traditions and consumer behavior. With the number of weddings declining and more couples opting for smaller, less formal ceremonies, demand for traditional bridal gowns has plummeted. Younger consumers are increasingly turning to online retailers and international brands, seeking affordable, customizable options that fit their unique styles. Social media has also played a role, with influencers showcasing budget-friendly alternatives and DIY wedding ideas. Meanwhile, David's Bridal's large physical stores and inventory-heavy model have become liabilities in an era of fast fashion and e-commerce. The company's attempts to modernize, like launching online sales and offering more casual attire, have not been enough to reverse its fortunes. As wedding traditions continue to evolve, David's Bridal's future remains uncertain, serving as a cautionary tale for retailers slow to adapt. JCPenney, once a cornerstone of American retail, is now fighting for survival. The company, which has been around for over a century, has seen its fortunes dwindle in the face of relentless competition from fast fashion retailers, the explosive growth of Amazon, and a dramatic decline in mall traffic across the country. In the past decade, JCPenney has closed hundreds of stores, laid off thousands of employees, and filed for bankruptcy in 2020. Despite emerging from bankruptcy with new ownership and a slimmer footprint, the company continues to struggle to attract younger shoppers and adapt to changing consumer habits. Many analysts point to JCPenney's outdated store formats, lackluster online presence, and inability to differentiate itself as key reasons for its ongoing decline. If these trends continue, 2025 could very well mark the end of JCPenney's long and storied history. It's a harsh reality. No matter how big a company seems, it's never too big to fail. The market is changing fast, and only the most adaptable businesses survive. Which one of these companies surprised you the most? Let us know in the comments, and, hey, don't forget to subscribe to my channel for more updates on economic trends, travel insights, and smart global living. See you in the next one.